welcome to another edition of Nucleus Investment Insights. Coming to you a little bit early today. We've pre-recorded this and we'll post it up at the usual time, 12:30 on Thursday. Quick reminder that anything you hear today is general advice, not personal advice. If you don't want personal advice, then feel free to drop us a line. You can get everything from nucleuswealth.com/contact. Also, if you like what you hear, hit the like and subscribe buttons. And with no further ado, we'll jump sort of straight into what we're looking at. So, big focus today on productivity. So, it's very interesting. We've seen a few charts come out just recently for the 2023 showing Australia at the bottom of the productivity and the US at the top. And when you read US research and look into there's some quite interesting factors they talk about coming out that are driving it. And most of those factors also seem to like they should apply to Australia, but Australia is sort of sitting at the bottom. So, Leith, going to grab Leith Van Onselen. Welcome, Leith. Thanks for coming on.
G'day, Damien. How are you? G'day, everyone.
Is Leith's written something recently on Macro Business blog, 4 reasons for Australia's productivity problems, and so I thought it'd be worth getting him on to have a quick chat and run through what his thoughts were. So we might start with that OECD chart. Leith, the Poland at the top, but US right behind. Well, US, I guess, in terms of large economies, US right there, US, Norway, South Korea, sort of sitting at the top there, and right at the other end, Australia, Japan. So I'll open it with that and get your initial thoughts.
Yeah, so this data pretty much matches other data that Justin Farlow at Antipodean Macro has put out recently. So he showed that since 2018, so it's a bit. This chart here comes from Shane Oliver, and that's only for 1 year.
Just 1 year,
yeah. But Justin Farlow at Antipodean Macro, he's plotted Australia's labour productivity against a whole host of other advanced nations. So US, UK, Canada, the Eurozone, etc., and a couple other ones. And what it showed is that we've had the lowest labour productivity growth also since 2018. So that's more of a 6-year over that 6-year period. And so what it basically tells you is that Australia's labour productivity is very poor. And in my article, I basically put it down to 4 factors, which I can run through if you like.
Yep, that'd be good. Well, actually, I might even start. Can I start actually at the other end as well? So there's definitely, so we've got four reasons with yours, and I think most of those are relatively Australia specific. But say when you read research out of the US, it tends to have the slant to say one is the pandemic was productivity enhancing in terms of it being, hey, everyone all of a sudden had to do a whole bunch of things differently, and so it just meant that. I had, somebody who had some antiquated system that was taking time, they just had to digitize it because all their workers were at home, and so therefore, they picked up those benefits. Just needing to do stuff differently. Sort of, there's a bunch of different studies out there that's just showing if you force people to do something different, they might not stick with that whole thing, but they'll learn something from it, and they go, we had to work from home. Yeah, we're not going to do it full time, but actually, we learned 10 things that actually helped productivity, over the time. So that's one. And the other big one, I guess, is the AI boom and just that whole thoughts around what are the ways that, you can use AI within your businesses to enhance productivity. I think what other ones you get from the US, a little bit about the, I guess it probably is slightly one of the opposite of one of your answers, but this idea of saying, well, if you're actually constrained for people, so in terms of, and this sort of fits Australia a little bit, I guess, in terms of low unemployment rates, then you start to think about how can I do things smarter? I can't just go out and hire more people, which I guess you can in Australia. So therefore, rather than try and do that and destroy people at the problem, I'll buy a machine that can do the work or change ways. So I guess your thoughts on some of those as to how they apply to Australia and why I guess people in the US are saying that's affecting them and not Australia. So let's start maybe with the pandemic side.
Yeah, well, so certainly that there was a productivity bubble, I guess, during the pandemic. We certainly saw that in Australia, and also some other nations too. So that chart I referred to by Justin Farlow actually plots in a time series Australia's productivity since going back a decade, really. And what it showed is that labour productivity did spike across a lot of economies, but especially in Australia.
Yeah, but
during the
wasn't
pandemic.
that just because you took away a lot of people?
Yes, yeah. So so
Yeah,
so basically, when we had lockdowns,
yeah,
a lot of the low productivity services economy basically stopped, right? So
yeah,
the labour that was remained, you know, if you take out the low productivity workers who are doing the, you know, the sort of low skilled services stuff, you're going to get a productivity spike. But
yeah.
then as economies open back up, the productivity then fell again. Now,
And also
US is
the
obviously
part is
that's not quite.
if you're a company and you run into problems, you go, "Okay, I'm gonna get rid of my least productive workers first."
Yeah,
You know, I've just cut my earnings has just fallen by 10%. I'm gonna cut whatever 10% of my workforce. I'm gonna cut the ones that are the least productive, and I'll keep the ones that are the most productive. And so,
yeah.
yeah,
And to your point, you made the comment about how, you know, not having access to workers actually makes you more productive. Well, that's that's certainly true because if you can't just, for example, you know, grab someone from overseas,
mm,
you know, migrant who you can pay lower incomes to, you're actually forced to innovate and you're forced to invest in capital, you know, machinery, automation, that sort of thing, and then that boosts labour productivity. And although this yearly chart that from Shane Oliver doesn't show it because it shows Japan near the bottom for 1 year, but Japan over a long period has basically overcome its aging population problem with automation, and it's kept them, you know, number one in the world on the economic complexity index, for example, because it's, you know, it's done capital deepening, whereas Australia's done capital shallowing, which I can get into if you
yeah,
want.
yeah, yeah. Let's dig into those. Yeah, okay, yeah, that's probably a good start. Let's jump. I'll jump into this mining versus manufacturing chart. I guess that's probably I guess the first place to start.
Yeah, absolutely. So basically, I've put down Australia's productivity decline down to four factors. Now, you know, this is the four factors that I've picked out, which I've, you know, kind of thinking about the issue. And the first one was we obviously had the early 2000s, the commodity boom kicked off. And what that did was that actually raised Australia's real exchange rate. So it pushed the Australian dollar up for the roof. Some of you might remember that for a period there, you know, in the late 2000s, I think it was, Australia was, our dollar was worth more than the US dollar. And, and what that did was that it basically made Australian manufacturing less competitive and more expensive. So we got what economists call Dutch disease, whereby the real exchange rate rose. We became less competitive as a manufacturing nation because import competing manufacturers became cheaper, or we couldn't export overseas. And as a result, our manufacturing sector shrunk as a share of the economy. So, um, you know, Australia's manufacturing share in about 2000 was about 12%. It's now fallen to under 6%. And that's happened over a sort of 20-year period.
Yeah,
And
and actually, just for anyone listening to the podcast, this is showing is it's got the manufacturing starting at sort of 15-16% back in the
70.
70s and ending up at 5%. And meanwhile, mining sort of headed the opposite direction,
Yep.
starting at sort of 8 or 9% and heading up to 17 at the peak. But it's had quite a sharp decline in the recent ones back to 13 at the moment.
Yeah, so it kind of looks almost like a bit of a funny looking X. It's not a perfect X, but you know,
Yeah,
manufacturing's gone downward, sloping down, mining's sloping up, but not perfectly.
yeah,
And the reason why this matters for productivity is that most of the productivity growth in advanced nations has come from manufacturing, because manufacturing is subject to global competition. It's also subject to, you know, using new technologies, very capital intensive. So generally speaking, you know, countries with high levels of manufacturing, higher proportions of manufacturing tend to have higher labour productivity. And because Australia's manufacturing sector's shrunk so much, and our manufacturing sector is now the lowest in the OECD at just over 5%. We've got the lowest manufacturing share. It's meant that we've pivoted towards services, which tend to be much lower productivity. And that's one of the reasons why Australia's productivity growth has been on, you know, sort of terminal decline. Added to that, the second factor, and this is kind of related to manufacturing at least, is that we've engineered stupidly really high energy prices in this country. So we used to have some of the cheapest energy prices in the world. You know, incredibly cheap gas and incredibly cheap electricity, and that made our manufacturing more competitive. You know, it gave us a competitive advantage in that area. Unfortunately, through, you know, I could talk about it all day, but through a series of energy policy failures, most notably not reserving our gas on the East Coast for domestic use, opening up LNG export terminals a decade ago, and linking our gas market to the, you know, the global price. we've effectively rammed up the cost of gas, which has then increased electricity. That's made our manufacturing also less competitive. And the last couple of years, we've seen a whole bunch of manufacturers close down. And the most significant one this year was Queenos, which was Australia's last plastics manufacturer. That's now shut down. Obviously, we saw the car industry, et cetera, shut down, years ago, not related to the energy, but to the high Australian dollar, et cetera. And all these two factors, the mining boom and then the energy shock, is basically shrinking Australia's manufacturing sector, and that's contributing to the lower productivity.
Mm.
And the latest Harvard economic complexity survey showed that Australia's economic complexity has fallen from about 60 in the year 2000, which was bad, to 102 currently, which is dire. And we're now ranked for economic complexity with 2-bit African nations. We're actually below Bangladesh and Senegal.
Mm.
And the main reason for that is because our manufacturing sector is now the lowest in the OECD.
Yeah. And some of this as well, like in a big picture sense, if I sort of added these two lines together, you go, okay, so we add them two together, we're at sort of 25% for mining and manufacturing together, for a lot of that time period, and that sort of, matches or whatever. And then all of a sudden we go probably slightly above that in 2010 type thing. But then but here we're seeing exactly the problem with mining on the other side, isn't it? Where you have that sudden decline post, is that your mining goes through cycles.
Yeah.
And when it switches off, and manufacturing doesn't switch back on again. It takes a long time to let's say the car industry, once that's gone, you've lost
Sure.
lost all the knowledge and all that type of stuff. And so, to get it back again just takes decades of, industrial policy and
Yeah.
changes to build up those types of things.
And it's likely those things will never come back, especially when we've now given ourselves expensive energy costs.
Yes.
Right, because Australia's obviously got tyranny of distance. We've also got high land costs. We've got relatively high wages, but we used to have cheap energy was an offset. Now we've got expensive energy.
Yeah.
So it's really who's going to manufacture in Australia when you have those conditions? And as a result, we've just become basically a services and mining based economy, which mining's boom bust. Services tend to be low productivity, especially the way we do it, which I can get into in a sec. As the third, actually, I'll get straight to the third factor. The third factor is another long running one that's happened really since the early 2000s. And, economist Jared Minnick's done some fantastic data on this. But it's Australia's suffered, and so has Canada for this matter, for the same reasons, suffered from what economists call capital shallowing. So what's happened is Australia's population has grown by 8.5 million people this century. So we've had enormous population growth, obviously through, historically high net overseas migration, which got ramped up in the mid-2000s. And it's been running hot for 20 years. And what that's done is our population has grown faster than the rate of business investment, infrastructure investment, and housing. And what that's done is it's meant that we've got less capital per worker, and our labour productivity, it's put down, it's basically reduced our labour productivity. Now, in order to explain this capital shallowing stuff in a basic sense that people can understand, I've used this example a few times. Imagine you run a cafe and you've got one coffee machine and two workers that use that coffee machine, and they can produce 50 coffees an hour. Now, if you double the number of people to 4 sharing that one coffee machine, you're not going to double your output to 100 coffees per hour, because they're going to have to wait for each other. They're going to bump into each other. You're going to get congestion in the cafe, etc. And that's so you actually get lower labour productivity, and that's kind of a stylised example of the sort of thing that's happened to the Australian economy. We've grown the population aggressively, but we haven't provided the extra capital for all the extra people that have come here.
Yeah, well, I'm going to fight against your analogy too, I think, Leith, and saying we've shut down the car factory and we've employed a bunch more baristas as well. So it's
Yeah, no, yeah, absolutely. No, that's certainly happened. I'm just trying to give it.
no, I get it. I'm just, which is not that productivity enhancing either. But
No, but yeah, I'm trying to give a style. Because when you use terms like capital shallowing, it's easy to someone go, what's this guy talking about?
Yeah.
Well, it's
and the kids of today don't know what a factory is. But they do understand a barista.
Yeah, and it's the basic sort of, if you got 2 people sharing one coffee machine, then you have 4 people sharing the one coffee machine, you can't make as many coffees. And that's kind of, a stylised example to what's happened to the Australian economy, with not enough investment in businesses and infrastructure. So we've got more congestion, that sort of thing, and also not enough houses to house the workers. and then ultimately you end up with lower productivity growth.
Mm.
So that's the third factor,
But
and the
and so the other I've got that chart up there of that decade of low investments, and just for anyone listening in on the, podcast, so basically what it's showing is sort of or if you look back to the '60s through to the '90s, investments ran at sort of 10 to 14% of a percentage of, GDP. And then basically since you had the recession in the '90s where it fell precipitously, and then since then it never really made it back. And if you separate it into the, mining as well, particularly in that sort of whole 2000s period, yeah, we had a reasonable amount of mining investment that sort of got it back to 12%, but the ex-mining one was never that good. And the last, since 2012, we've gone from averaging 10%, over the 50 odd years before that to 5%. We've sort of halved that rate of, net investment as a percentage of GDP.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with the investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
What were some of the other ones you had there? The capital deepening one, the growth in real capital stock per person. So that's sort of illustrating, I guess, Leith, if you want to talk through that chat.
Yeah. So at the same time as we've had less capital investment, we've also grown the population aggressively. So what that's meant is that the amount of capital per worker has shrunk, and or at least it hasn't grown as it used to grow. So it's either capital shallowing or less capital deepening, whichever way you want to talk about it. And that's one of the contributors to Australia's productivity decline. We're growing. Our economy has shifted away from growing through more capital investment to growing through more people.
Yeah, well, that's sort of that story, that you'd hear 20 years ago from people coming out of India, and they'd be talking about saying, there's a construction site, and there's a whole bunch of people sitting there with big sort of metal plates sort of digging the ground out. And you'd say, "Well, why don't you just get a tractor to do it?" And you're like, "Well, you know how much a tractor costs, I can pull in 100 cheap peasants to dig this stuff up really quickly, sorry, really cheaply, and I don't wanna spend money on a tractor." Whereas, obviously spending that money on the tractor and educating people and getting them to do more each other stuff is a way sort of economies grow. It's basically Australia sort of seems to be headed back towards that other direction in terms of we just keep bringing more people in, so therefore people start saying, "Well, actually, maybe I don't need to buy that tractor after all. I'll get a bunch more, students on their 20 hours a week and, yeah, and 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 pay low rates for those."
Yeah, absolutely.
Um,
And that gets back to your first point. You said earlier, when you have a constant flow of supply of workers, and there's always a bit of slack in the labour market, you're not as incentivized to automate and do things like Japan's had to do,
mm,
because they've got a shrinking population. So you go over there, and they've got they've automated heaps of stuff, and as a result, they're very complex economy, and obviously massive manufacturing sector. They run current account services through selling to the rest of the world, and very advanced economy, despite the fact that they got a shrinking population.
yeah, yeah. Excellent. Okay, so that's one of
Number
the
3,
number 3?
and
Yep.
and number 4 has been the bloating of this sort of non-market government type jobs. So um, the latest national accounts that came out a few weeks back, the Q3 national accounts, showed that government public demand, so it's basically government spending, hit a record high, nearly 28% of Australia's GDP. So that's up from about 21%, about 8 years ago, or a sort of longer term average of about 20-ish%.
Yeah, so
And
I've got that long-term chart up of, yeah, percentage from your article, just showing that sort of Westpac economics ones.
yeah,
So ran at sort of 20 to for anyone listening in, yeah, ran at that sort of low 20s for from 1970s, early 1970s up to 2016, and then it's just been a rocket ship since then, from 21% in 2015, 2016 to almost 28% now.
Yeah, and a lot of that extra government spending has actually gone to non-market jobs. So what a non-market job is, not just the public servant. So it's easy to think, oh, it's public servant. It could also be private sector employees who are funded by government. So, for example, if you're an NDIS, private NDIS provider whose funding is dependent on government spending, includes that. So it's anything that's not in the market economy, not in the sort of private sector economy. And if you actually go back to it, basically the non-market sector and the market sector jobs grew in tandem up until about 2008 when they diverged. So since 2008, the non-market sector, so the government-aligned jobs, have grown by 82%. But the market sector, so that, like the private sector, jobs are only growing by about 20%. And so effectively, our economy's become a lot more dependent on public spending. And in recent years, those non-market jobs have absolutely ballooned. The last 2 years, for example, pretty much all the jobs growth in Australia has come from the non-market economy. And a lot of that relates to the NDIS. So the NDIS is up until now has grown by about 20% per annum since 2015. It's worth about nearly 50 billion a year in spending, and it's projected to grow to nearly 100 billion in a decade. And those NDIS type jobs, it's created a jobs boom in sort of caring jobs, and those have added to these non-market jobs. And the problem with it is that these non-market jobs have historically been very low productivity. So in this chart pack, we've got a chart that was done by Justin Farber, at Antibody and Macro, and it shows that Australia's total labour productivity is tracking at 2016 levels, but in the non-market sector, which, as I've said, it was dominated jobs growth, 80% growth since 2008, labour productivity is actually tracking at the same level it was 2 decades ago. So it had zero growth in the non-market sector labour productivity for 20 years. And that's basically dragged down Australia's labour productivity growth because our labour market has been so skewed so heavily towards this non-market sector.
Yeah, and I just want to highlight as well, we're certainly not denigrating NDIS in terms of being valuable contribution to Australian society. It's more just saying the way it's been set up is just a magnet for scammers and people who want to just overcharge, and there's just nowhere near enough checks and balances for something with that size. And I guess I just want to do a quick comparison with the energy sector. Like we had this monopolistic energy sector that was all government run, and then we set up these boards. We privatized it all, set up all these boards in order to outsource and sell off all our poles and wires and all that type of stuff like that. And like clockwork, every 5 years, all of a sudden we realize, hey, we've been ripped off for the last 5 years, and they go and put a bunch more rules in. And then the market participants are very efficient, and they manage to work around those rules, and then they do the same thing again. And that's basically what's happened in the NDIS, in my view. Except the problem with the NDIS is, at least in the energy sector, there's 5 or 6 big players, and you know who they are, and you've got a board and you can regulate them. In the NDIS, there's hundreds of thousands of people provided services, and it's just impossible very difficult to try and regulate that. And so that keeps coming back to that question: is why do you want this? Why do you want the private sector to do this? And because they're more efficient. It's like, well, are they more efficient at providing the services, or are they more efficient just at taking money from publics? Yeah. Anyway,
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Yeah.
Hi, Rent.
No, mate, you're 100% right. And just on that energy sector thing, it's not just the fact that we've prioritised everything and we've gotten worse outcomes, but it's also you know, when it was publicly owned, they never had to spend on advertising and things like that to try and
Yeah.
to try and compete with each other for your business. Now we're wasting money on advertising.
Yeah.
So like if you're an AGL or whatever, they spend a lot of money on advertising now.
And it's the same electrons.
Yeah, exactly. It's the same electrons.
Origin where we get it from AGL, it doesn't actually doesn't affect where my energy actually comes from. It comes from the sun power plant.
Pure waste.
It's just yeah,
it's pure overhead. So we've got that sort of stuff as well. So unfortunately, the economy has become more reliant on public spending, and as well as the immigration thing, which has helped create the capital shallowing stuff.
Yeah,
but had this massive boom in these non-market jobs, which is just, I'd argue it's crowded out the market sector, the private sector. And that chart I was talking about, whereby the non-market government jobs have had zero productivity growth in 20 years. Well, the market sector's actually had pretty decent productivity growth in the last 20 years. So
yeah,
as the economy's pivoted away,
30% up or something like that.
Yeah, that's right.
Yeah.
It's up by about 30%. The non-market sector's had 0% productivity growth. If the economy keeps pivoting towards this non-market sector and that becomes a bigger share of the economy, well, then we're going to get less productivity growth going forward, and it's just going to end up being a drag on the aggregate economy. And those are sort of the four factors that I've plucked out for Australia.
And I think there's certainly I guess for anyone sort of listening in who's still a bit is this a bit esoteric and does it matter or whatever? I think that some of the key parts in terms of the way we see economies grow, and I guess I'll throw this back to you in a second, Lee, for your thoughts on this. But there's, I think it's Paul Krugman quote saying, in the short run, it's productivity doesn't make that much difference, but in the long run, it makes all the difference. So over a 10, 20-year period, if you're not getting productivity growth, then you will definitely be falling behind other countries, and you'll be losing out on economic growth and all those types of things. And so, Leith, just your thoughts around sort of labour productivity and how it actually fits for a company's profitabilities and the profitability of Australia as a whole.
Yeah. So, I mean, as you said, it's absolutely fundamental. Basically, productivity is just doing more with what you've got, effectively. So, instead of working, 8 hours a day for X, you can work 6 hours a day. It gives you 2 hours to do other stuff, or you can work 8 and still work 8, but get more out of your 8 hours. So it's absolutely fundamental. You can't really have rising living standards without productivity over the long run. It's basically been the bedrock of how the modern economies have grown for hundreds of years, really. And it's relied on not just doing things better, but also obviously new technologies, investment in new machines, all that sort of stuff. But unfortunately, Australia, we've kind of fallen behind in a lot of those areas, and the structure of the economy, unfortunately, since the mining boom and through all these other factors, has become less complicated, unfortunately, and it's become less advanced, and that's why we've fallen down the complexity rankings. Those Harvard complexity rankings rank 150 nations, and we were 60 out of 150 at the turn of the century, which wasn't flash, but it was okay, I guess. It was in the second third, but at the very best of the second third. Now we're in the bottom third, and we're up there with all the all the sort of African nations that most people have never heard of for economic complexity. And a lot of that's because our manufacturing shrunk, unfortunately, to almost nothing. And I'd say, do we really want to be a nation where we don't build anything anymore? I'm not. We're never going to be building Boeing jumbo jets or anything like that here, but we can't even manufacture our own tin cans to put our canned fruit and vegetables in anymore. We've gotten to a stage now where Nestle and a few other food makers are now saying that they're looking to leave Australia because the energy costs are too high and it's too expensive. So it's become a bit of a fundamental issue here now, I think, whereby we can't even we can't sort of make anything anymore, even just basic stuff. and it's just becoming outsourced and going overseas. A lot of that's because of it was because of the high Australian dollar, but that's not as much of an issue now. Now the issue is high energy costs. That's the thing that's crippling the economy.
Mm. And so, I guess from an investment perspective, when we look through and we're looking at companies, and I guess it's important from my perspective to say, look, not every manufacturer that might be listed in Australia actually does most of their manufacturing in Australia. So it's always a question about where are they actually doing these factors. But as you said, it's none of these look like changing. I guess there doesn't seem to be any, as much as we're speaking about these being problems, if you're talking about some fundamental changes to the systems, and some changes to sort of reorient things back, then you can actually start looking at saying, well, where are the beaten down companies that have been copying it for years, and these changes come through now. I can actually buy them, close to the bottom, and but we've had, as you said, 20, 30 years of just declining manufacturing year on year on year, and it looks like we're set to continue. Like, it doesn't seem to be anything changing as far as I can see.
Yeah, well, the only thing that might change, and this is artificial and not necessarily a good thing, is the federal government with Albo's future made in Australia or whatever starts throwing billions of dollars of our money at picking winners in manufacturing. That could increase the share marginally, but it's not. But that's artificial. It's
Yeah.
we'll end up with manufacturers that are only producing because they're getting government handouts, not because they're actually good at what they're doing. And the underlying solution to it is actually to fix the energy market and deliver Australia once again cheap energy. And then you can then the manufacturers, manufacturing should expand off its own accord, because Australia would suddenly become, a cost-effective place to manufacture if we had dirt cheap energy, but or a more cost-effective place, I should say, not necessarily the most cost-effective. But unfortunately, we've given ourselves neither. We've got expensive land, relatively expensive labour, and also uber expensive energy now. So it's really a crossing every box.